Let me begin with an uncomfortable truth. Most people who believe they are being careful with money are actually guaranteeing their own loss, not through bad luck, not through market crashes, but through simple math that almost nobody bothers to run. Cash feels safe because the number in the bank never moves. But safety is not what the number shows. Safety is what the number can buy. And every year, quietly and politely, inflation steals a little more from you. If prices rise faster than your savings grow, you're not avoiding risk. You're choosing a slow, predictable decline. It's financial erosion disguised as stability. People fear volatility because it looks scary on a chart. But they ignore inflation because it doesn't flash red. It whispers. It shrinks your future softly enough that you don't notice until entire decades disappear. In the next few minutes, I'm going to show you why the real danger isn't losing money in the market. The real danger is sitting still. Because one thing feels safe, and another thing is safe, and they are not the same. Inflation is dangerous not because it is dramatic, but because it is invisible. It doesn't crash suddenly like the stock market. It doesn't create panic. It simply shows up every day, raises the cost of living by a tiny amount, and waits patiently for you to ignore it. That is why it destroys more wealth than any market crash ever has. Most people imagine inflation as an inconvenience. Groceries cost a little more, rent rises, a cup of coffee becomes strangely expensive. But inflation is not an inconvenience. It is a slow, permanent leak in your financial life, a leak that never stops, a leak that compounds, a leak that punishes the people who think doing nothing is safe. Here's the uncomfortable arithmetic. If prices rise 3% a year, but your savings grow 0.5%, your money is shrinking 2.5% annually. That sounds small, but small numbers become big problems when they compound. Over a decade, that safe cash loses roughly a quarter of its real power. It still looks the same on a bank statement, but it does less, buys less, protects you less. Inflation is like termites in a house. You don't see the destruction happening. The walls still stand. The roof still looks fine, but the structure is hollowing from within. One day it collapses, not because of one big event, but because of 1,000 tiny bites that were ignored for years. Volatility scares people because it's loud. Inflation should scare you because it's quiet. You can watch a portfolio drop 15% in a bad year. You feel it, you react, you talk about it, but you don't feel a 3% inflation loss. Even though that loss is permanent, you don't get it back. The world doesn't refund higher prices once they rise. Inflation takes and keeps taking. This is why holding too much cash is not caution, it's erosion. It is the financial equivalent of standing still on an escalator that is moving downward. You feel stable, but you're sinking. People tell themselves, I'm waiting, I'm being careful, I'll invest when things calm down. But inflation never waits. It keeps charging its quiet tax while you wait for perfect conditions that never come. And the cruel irony is this: the very moment people cling hardest to cash, the moments when fear is highest, are usually the moments when future opportunities are greatest. But fear focuses on the possibility of losing money tomorrow, not the certainty of losing purchasing power today. Inflation punishes hesitation. It punishes the passive. It punishes the saver who never becomes the investor. The only real defense is to own something that grows, something that adapts, something with the power to raise prices when the world becomes more expensive. Cash can't do that. It sits still while everything else moves. Inflation is not the enemy of the rich. It is the enemy of the unprepared. And the people who suffer most are not those who take thoughtful risks, but those who take none at all. If inflation is the silent thief, then productive assets are the only guard strong enough to stop it. Not cash, not idle money sitting quietly in a bank account, but assets that work while you sleep, that grow while prices rise, that fight back instead of surrendering. Let's begin with the most important one, productive businesses. Most people call them stocks, but that word has become too abstract. A stock isn't just a symbol on a screen. It's a piece of a real company doing real work in the real world. And great companies don't sit still when inflation rises. They adapt. They raise prices. They innovate. Their earnings grow. And when earnings grow, your piece of that business grows with it. Think about what happens when the cost of sugar, transportation, or labor rises for a company like Coca-Cola. They don't freeze. They don't accept the loss. They raise their prices a few cents. Billions of people still buy the product, and your ownership quietly benefits from that pricing power. That is something cash will never accomplish. A productive business is like a living organism that gets stronger over time. Cash, in comparison, behaves like food left out in the sun. It spoils unless you use it quickly and wisely. Now, the second type of productive asset, income-generating real estate. And I want to be very clear, not speculative property, not a condo you hope will rise in price because the area is hot, and not land that sits empty waiting for luck. I'm talking about property that produces actual cash flow, rent that arrives every month, income that adjusts as the world gets more expensive. When inflation rises, rents tend to rise with it. Meanwhile, if you hold a fixed mortgage, you're paying back that loan with cheaper dollars every year. Inflation becomes fuel for your wealth instead of a threat. Productive real estate works because it performs two roles at once. It gives you income today, and it protects your purchasing power tomorrow. It is both a shield and a sword. But here's the part most people ignore. None of this works if the asset doesn't produce. A business without earnings is speculation. A property without cash flow is speculation. Speculation is hope. Productive assets are discipline. The difference between the two determines who survives inflation and who gets eaten by it. But why do productive assets win in the long run? Because they harness the one force inflation cannot defeat: human ingenuity. Every productive business is powered by people solving problems, creating value, building products, and responding to change. Every productive property is tied to real needs: shelter, commerce, community. These are timeless. People will always need them. Inflation raises the price of everything, but productive assets own the things inflation raises prices on. That's the fundamental advantage. Cash is a spectator. Productive assets participate. Cash watches the world become more expensive. Productive assets make the world more expensive and profit from it. This is why the wealthy don't fear inflation. They own things that grow when everything else grows. They don't store their money in a vault. They store it in machines, buildings, brands, and systems that never stop working. If you want to stop losing to inflation, step one is simple. Stop depending on idle money and start owning things that do something. In the next segment, we'll talk about the most powerful productive asset of all, An asset people forget more often than anything else: themselves. Before we talk about any portfolio, any market strategy, or any asset class, we need to confront a truth most people avoid. The greatest productive asset you will ever own is the one you're walking around in every day. Your skills, your knowledge, your ability to earn, your capacity to solve problems. People obsess over stock tickers. They compare real estate yields. They debate interest rates. But almost nobody asks the simplest and most profitable question: how valuable am I becoming? Because here's the reality. A person who increases their earning power by 20% has created more lasting wealth than most investors earn in the market over multiple years. And it doesn't matter what inflation does. It doesn't matter what the S&P 500 does. It doesn't matter if the world becomes more expensive. Your skills travel with you everywhere. They can't be stolen. They don't crash. They don't require permission from the market. A bank account can shrink quietly. A portfolio can swing violently. But your ability to create value for others, that is the one asset inflation cannot touch. The problem is that people avoid this investment because it doesn't feel like investing. Buying a new skill doesn't feel like buying a stock. Improving your thinking doesn't feel like collecting dividends. Learning a higher income trade doesn't feel like owning a rental property. But the math is brutally clear. If you use $5,000 to buy a stock, maybe you earn 8% a year. If you use $5,000 to build a skill that increases your income by $10,000 a year, that's a 200% annual return, and it compounds every year you continue to earn. No stock does that. No bond does that. No real estate deal does that. Your skills are the only asset that can outperform the market because you are the engine behind the growth. Benjamin Franklin said, "An investment in knowledge pays the best interest." He wasn't being poetic. He was being literal. Think of your earning power as the present value of all your future income. If you're 30 and expect to work until 60, that's 30 years of income ahead of you. A small improvement to that income stream becomes massive when multiplied across decades. But here's the trap. Most people protect their cash instead of upgrading their abilities. They cling to a savings account, earning 0.5% while their skills become outdated. They're so afraid of losing a few dollars that they never gain the earning power that would have made all the difference. This fear keeps millions stuck. Fear of looking foolish, fear of failing, fear of stepping outside the familiar, fear of becoming a beginner again. But the truth is simple. The market rewards competence. It rewards people who can think clearly, solve problems, understand systems, communicate well, manage people, or operate tools others can't. You don't need 20 new skills. You need a few valuable ones, skills that generate income, that reflect real market demand, that make other people's lives easier. I spent my life studying widely, law, psychology, mathematics, physics, business, because the real world doesn't hand you problems in perfect categories. You need tools from every toolbox if you want to see reality clearly, and that is the final secret. Your mind is the only asset whose value compounds faster than inflation. Every book you read, every discipline you learn, every mistake you analyze, every insight you practice, they all stack like layers of armor protecting you from uncertainty. Inflation can erode cash. Markets can swing, But your ability to create value is the one asset that grows with you, adapts with you, and pays dividends for the rest of your life. In the next segment, we turn to something most people misunderstand: how to use safe assets, like selective high-quality bonds, not for growth, but for optionality, the freedom to act when others can't. Uncertainty frightens most people, but it shouldn't. Uncertainty is where nearly all great opportunities live. The problem isn't that people face uncertainty. The problem is that when uncertainty arrives, most people are not prepared to act. They're frozen. They're stuck. Their money is trapped in places that punish them when they need flexibility the most. That is why optionality, your ability to move, adapt, and seize opportunities, is one of the most underrated financial assets in the world. And this is where high-quality short-term bonds play a quiet but powerful role. Not because they make you rich, they won't. Not because they beat inflation, they usually don't. But because they give you something cash often fails to give: flexibility without paralysis. Think of short-term bonds as temporary parking spaces, not destinations, not homes, just a safe, liquid place to hold capital while the world makes up its mind. They pay better than cash. They move less than the stock market. And most importantly, they allow you to stay patient without staying idle. This is a mental model most investors misunderstand. They treat bonds as safety. But bonds were never meant to be permanent. Bonds, especially short-term, high-quality ones, exist to preserve optionality, to give you the breathing room to wait for real opportunities instead of forcing bad decisions. Warren Buffett uses this idea every decade. He rarely holds much cash. Instead, he keeps enough liquidity through cash and equivalents to act decisively when others panic. He doesn't wait for perfect conditions. He waits for mispriced conditions. Those moments only reward the prepared. Optionality is not about predicting the future. It is about being ready for whatever future shows up. Most investors do the opposite. They lock their money into long-term bonds with low yields because it feels safe. But low-yield, long-term bonds are not safety. They are a trap. They steal your flexibility for decades and hand you back devalued money in the end. Short-term bonds, in contrast, keep you nimble. If inflation rises, you can roll into higher yields quickly. If markets crash, you have liquidity ready to deploy. If uncertainty spikes, you are protected without being paralyzed. Optionality is wealth. Flexibility is wealth. Liquidity, held correctly, is wealth. But the key is correctly. Too much cash and inflation eats you alive. Too much long-term commitment and opportunity passes by untouched. The balance is simple. Hold enough to act, not enough to rot. Optionality is the art of leaving the door open just wide enough for opportunity to walk through. And in the next segment, we'll talk about the final category of assets. Things people often overlook because they aren't glamorous, but they're deeply practical. Tools, land, equipment, and hard assets that actually produce value in the real world. When people hear the phrase hard assets, they often picture gold bars, safes, or collectibles kept in glass cases. But here's the truth: almost nobody says out loud. An asset that just sits there is not a real asset. Not in a world ruled by inflation. Not in a world where productivity determines survival. The real hard assets, the ones that quietly build wealth over decades, are the tools, land, and equipment that do something. Assets that produce, assets that generate value, assets that keep earning even when the financial system catches a cold. Think about a piece of farmland that grows crops year after year. You're not sitting around hoping someone will buy it for more money someday. It produces food. It produces income. It produces value independent of market moods. Or consider a piece of machinery that enables a business to operate. A bakery oven, a construction excavator, a delivery vehicle. These aren't glamorous assets, but they turn effort into income. They convert labor and raw materials into something the world wants. That is real, durable wealth. Even at the personal level, a reliable car that allows you to work or run your business is a hard asset in disguise. It converts mobility into income. It multiplies your earning capacity. It pays for itself over and over. This is where the distinction becomes clear. Some assets inflate with the world, but others produce in the world. The second category is vastly more powerful. Gold doesn't produce anything. Cryptocurrency doesn't produce anything. They may have their uses, but they rely entirely on the hope that someone will pay more for them later. Hope is not a strategy. Production is. Useful hard assets shine in uncertain times because they remain valuable even if financial markets malfunction, if stock prices fall, farmland still grows crops. If currencies wobble, tools still build houses. If volatility spikes, equipment still helps produce the goods and services society relies on. These assets anchor you to the real economy, the one that survives every bubble, every trend, and every panic. And here's the deeper mental model. A productive hard asset converts inflation into revenue. As prices rise, so do crop prices, construction rates, transportation fees, service costs, rental fees for equipment. These assets don't fear inflation. They participate in it. Cash loses value, but productive hard assets often gain value. Not because people speculate on them, but because they continue to perform their function in a world where everything becomes more expensive. This is the dividing line between assets that survive inflation and assets that beat inflation. You don't need to own a farm or a factory to benefit from this principle. You just need to think clearly about what you own. Does it sit or does it produce? Because in a world where everything drifts upward in cost, the safest thing you can own is something that rises with it. And now, in our final segment, we'll pull all of this together, the math, the psychology, the 5 asset classes, to reveal a truth most people never learn until it's too late. One thing only feels safe. Another thing is safe. And the difference defines your financial future. Most people spend their entire financial lives chasing the feeling of safety, not real safety, just the feeling of it. A bank balance that doesn't move, a number that behaves, a calm screen with no volatility. They cling to these illusions the way a child clings to a blanket, comfort first, reality second. But here's the truth that separates those who build wealth from those who watch it slip away. What feels safe rarely is, and what is safe rarely feels comfortable at first. Cash feels safe because it stands still. But standing still in a rising world means falling behind. Every year, prices drift upward, quietly, relentlessly. And every year, your money loses a little more of its ability to protect you. Not loudly, not violently, just inevitably. Productive assets, businesses, real estate, skills, tools don't feel as peaceful. They move, they fluctuate, they challenge your patience and your psychology. But they grow, they adapt, they fight back against inflation instead of surrendering to it. Real safety is not the absence of movement. Real safety is the presence of growth. The world rewards those who own what the world needs: food, shelter, energy, skills, businesses, tools, systems, ideas. These are the engines of progress, and the people who own the engines, not the spectators, are the ones inflation can never defeat. If you take nothing else away from this conversation, take this: your financial future is determined not by your intentions, but by your decisions under fear. Do you seek comfort in what feels safe, or do you choose the discomfort that leads to true security? Write down your answers to the 5 questions we covered earlier. Be brutally honest with yourself. Where is your money sitting? What is it doing? What will it be worth 10 years from now? Are you treating cash as a tool or as a hiding place? Because all wealth building comes down to a single habit: the courage to act rationally when your emotions beg you to play it safe. Warren and I didn't become wealthy by being fearless. We simply refused to let fear make the decisions for us. We chose productive assets over comfortable illusions. We chose growth over decay. We chose math over emotion. And we stuck to that choice long enough for compounding to do the heavy lifting. You don't have to be brilliant. You just have to stop being systematically unwise. You just have to stop volunteering for the guaranteed loss that inflation delivers to the passive saver. The next decade will reward those who think clearly, those who choose assets that do something, those who build skills instead of excuses, those who embrace volatility while protecting purchasing power, those who understand the difference between feeling safe and being safe. The choice is simple. You can cling to cash and watch your future shrink quietly, or you can take ownership of productive assets and let your future expand. One feels safe. One is safe. Choose wisely.